Hey, what's up guys? It's Ezekiel Chiu here. So today I'm gonna show you how to buy low and sell high. I mean, this is what everybody wants, right? Buy low and sell high using the discount and premium method in trading. You're also going to learn the impulsive and correction moves in the market and how to apply them for advanced trading. So this is going to be a video that takes your trading to the next level. So first off, what is the discount and premium in trading, right? For example, in Forex trading, right? A currency pair is considered to be trading at a premium when the price is what? Elevated. It's exceeding its baseline, its intrinsic value. So it can be for Forex, it can be for stocks, it can be for crypto, it can be for anything. So on the other hand, when that pair trades at a discount, the price is lower, possibly dipping below its actual worth. Okay, so now let's start with the basics. So the market constantly moves in what? In impulsive and corrective waves. So this is what? This is a fractal nature of the market that is driven by the behavior of all the participants in the market, reflecting their buying and their selling actions. So this is important to understand the overall theory behind the market. So when the sentiment of market is bullish, so traders are what? They are optimistic about that pair. For example, a currency pair, a stock, or any vehicle out there. So they tend to what? When they are optimistic, they tend to buy it, which results in an impulsive move in one direction. So this upward momentum reflects what? Strong confidence in this currency or this stock's potential. However, as the price rise, some traders may start to feel that maybe this currency is becoming kind of overvalued, and they decide to what? To take profits off. So some people may also go short, which can trigger a pullback, or what you call a correction in the market. Next, when the market sentiment is bearish, traders are pessimistic about the currency pair, for example. So they tend to sell it, which results in an impulsive move in the opposite direction, downwards. So this shows what? Lack of confidence of this currency's value. So as price falls, some traders may start to feel that it's kind of becoming, maybe this currency pair is kind of becoming oversold. So they decide to what? To buy it back, which can trigger a retracement as the market could be temporarily reverses the direction. Okay, so impulsive waves often push the price with greater distance with momentum. So they are what? They could be characterized by the same colored candles with large bodies. So this what? This shows and reflects strong market movement in a single direction. Now, corrections, they represent what? Indecision in the market. And that could be marked by what? Mixed color candles with small bodies and kind of sideways wicks. This indicates lack of a strong directional movement. So identifying the end of the pullback and the start of an impulsive move can be highly profitable. This is kind of like buying low. So this will allow you to capitalize on buying opportunities or selling opportunities in the market at all these prime spots, which is what we talk about, right? Buying low and selling high. Let's say we are in an uptrend. And then what? If you're in an uptrend, we want to what? We want to buy low, right? And then we want to sell high, right? To benefit from this bull market. But we cannot open a buy position right now, right? Because the price is too high and it could drop at any moment. So we would want to wait for a correction so that we can enter at a better price. Now, the latest impulsive move has started from here and pushed the price higher all the way up to here. The correction will occur within this range. And once the market kind of gathers enough liquidity and the buyers now starts to come into play, that's where it will continue to push the price higher again. If price breaks below this level, it shows that what? The buyers are no longer in control, and the entire concept of an uptrend would now be questionable. So this would indicate what? A significant, now like bearish momentum, and then it means what? A potential reversal downwards. So unless it's like a fake out where the market aims to gather liquidity below this low before taking off again. So now back to our correction range. So the question is, where should we place our entry, right? Our long position, and where should we enter the market? So if you enter too early, the price might make a deeper pullback. Right? That's always the case, right? And then you will end up losing even though your analysis is correct. Let's say eventually go up, but you entered too early. So on the other hand, if you waited too long, the price might start pushing higher without you entering, and then you miss the trade. So the key to trading with a strong trend is to identify the end of a correction, isn't it? And that marks the start of the next impulsive movement. But how do we do that? Okay, so this is where you can use the what? The Fibonacci retracement levels. You can apply this tool from the start of the impulsive wave to the end, because this will help you to identify the correction range. So when you apply this, right, you will notice all these levels will start to appear. These levels will act as support and reject the price when it reaches them. As price moves lower, it indicates what? A deeper retracement. For now, we only need the 50% retracement level. The area above the 50% retracement level is called the premium side of the range, and the area below it is called the discount zone. All right, so the 50% level is known as the what? The equilibrium level. Okay, when the market sentiment is bullish and we have a uptrend, you want to buy in the what? The discount zone for multiple reasons. So reason number one, safer entry. The market loves to take out early buyers and use them as liquidity for future movement. So waiting for the price to enter the discounted zone and then look for signals to go long will instantly increase your win rate. Obviously, every strategy has its pros and cons, right? Has its downside. So in this scenario, what will happen? You might miss some trades due to you being conservative trading. But a missed trade is always better than a losing trade, isn't it? Right? So reason number two, why entering a discount area is good, is the higher risk to reward ratio. So regardless of your entry point, the first target for the range is the recent level of the market structure. So when price reaches this level, right, some traders would close positions or take their profit. So some might go long. Now, this can lead to a correction or even an entire reversal. So therefore, making this our first target, right? Our first take profit target. So now, when you enter in the discount zone, obviously it's going to give you a higher risk to reward ratio. So we obviously all risk to reward ratio, you will always want to aim for more than 1:1. For me, I prefer a minimum of 1:1.5, which is why trading inside the premium zone would not be as profitable as in the discount zone. Reason number three, a safer stop. The best place to place your stop loss, ensuring safety from all the market fluctuation, is below the swing low. If price breaks this level, it signals what? A market structure shift. And then the bulls will work to support this level. The closer your stop loss is to this level, the safer it becomes. So this is the third reason why we enter our trades in the discount zone. So now, okay, let's recap for a bearish scenario. Imagine now we are in a downtrend and we want to sell high and buy low to benefit from the bear market, right? From the bear market, you want to sell at higher points so that you can go down lower. So for better risk to reward ratio. Now, we need to wait for what? A correction to enter at a better price. The latest impulsive move has started from here and then push lower all the way to here. So the correction will now occur within this range itself. And once the market gathers enough liquidity, the sellers will enter and then will continue to push the price lower again. So we will apply the Fibonacci retracement tool and define the discount and the premium zone. When the market is bearish and we are in a downtrend, we want to sell in the discount zone to capitalize on the downward momentum. So here's an important point. Impulsive moves can happen on also a larger scale. So for example, you can consider the market structure on a 1 hour time frame where we have two turning points for the market. The market was in a short-term uptrend, followed by a downtrend and then an uptrend again. However, if we check the higher time frame, these three structures are considered a single movement. If we apply the Fibonacci retracement to the latest impulsive wave, we would identify our discount and premium zones like this. There is a higher chance for price to enter the discount zone and potentially witness a reversal from here. Now, let me show you how to combine this now with the smart money concepts. Now, you can consider this structure as our higher time frame. So, when a change of character in the lower time frame appears, it signals a potential reversal. If the price contains enough liquidity and bullish momentum, the price will start pushing upwards. Otherwise, the price will continue to fall. Now, this scenario may repeat multiple times until the price gathers enough liquidity and momentum. So at this point, the price will take off and show the movements that, hey, we want to see. A more conservative way of trading, on the other hand, is to look for changes of character inside the discount zone. Take a look at this strategy, okay? The best way to predict whether we have a small correction or a large one is by what? Observing the previous market behavior. So this will help you to assess the strength of the trend and the potential retracement. In a strong trend, we will usually have small pullbacks with significant momentum. And with trends with deep retracement, we expect larger correction compared to a strong market. Now, the same concept is valid with optimal trading zones. So for example, if we look at the left-hand side, we can identify 3 fair value gap areas. So these gaps will act as support and push the price up higher. Okay, however, if you are looking to place a buy limit, the lower 2 gaps would be our preferred choice for entry. The difference between these 3 is that the higher one is located inside the premium range, while the lower ones are in the discount side of the range. So we are interested in buying in the where? In the discount zone. And then on the other hand, selling in the premium zone for better RR. So now this, in a way, conservative approach would result us in getting, hey, like I said, better RR, especially during deep retracements. Okay, however, during aggressive trends, buying in the premium side of the range can also be profitable. So it's important to remember that, hey, you won't win every trade, even with high quality setups. So the market may behave in a way being unpredictable, but with a good risk management, even say a 30% win rate can be really profitable. So you cannot control the outcome of a single trade. It's hard, but you can control the overall results of all your trades with proper risk management. So stick to high quality setups and stick to your trading rules, right? And that's where you'll be fine. Always backtest your trading plan before you use actual live money. So that's where you can build your confidence, and that's where you can also understand the performance first. So now let's look at some chart examples, right? And we're going to combine all the concepts that we have discussed. This is a 4-hour chart showing a clear downtrend with the recent bearish impulsive movement. So this sets the stage for us to apply our analysis using the Fibonacci retracement, the fair value gap, and the smart money concepts, so that we can identify optimal trading opportunities. Now, let's use the retracement tool, the Fibonacci retracement tool, to identify the premium and discount zones for the most recent impulsive wave. One important thing to keep in mind with live trading is that the waves are always expanding. We never exactly know where the movement will end. As much as you know you can read your charts well, you truly never exactly know where the movement will end. So adjusting our tools as the price develop is the key to being aligned with the market movement. Now, if the waves keep expanding, we simply just adjust the retracement tool accordingly. So now we have identified the zones. Is there a fair value gap in the optimal trading area? So if you look at the left hand side, we can mark this gap between the candles. Since this is a very tiny zone to look for rejections, let's also mark the candle that created this fair value gap as our order block. Now, this order block will act as a key area of interest, right? That's where you anticipate potential price reactions, and that's where you can plan your trade entries accordingly. This box here is considered our optimal trading area, right? That is located inside the premium side of the range. The idea is to wait for price to enter this zone, look for a change of character in the lower time frame to confirm the reversal, and that's where you go short. You see, now we are adding all this together. So now, another confirmation for this setup would be for the market to create what? Equal highs and then show a change of character. So this would signal a potential reversal, giving you more confidence in this trade setup as it indicates a shift in market direction. So first, we wait for price to enter our optimal trading area. Then you zoom into a lower time frame, such as the 1 hour chart, and that's where you observe the price action. This will help you identify potential entry signals and confirm the trade setup with better precision, right? So now, on the 1 hour time frame, we are looking for price action signal, right? Indicating this short-term uptrend is over. Okay, so that's where you can see that price can continue to push lower in line with the higher time frame overall direction, right? So this signal helps to confirm the reversal and then align with the overall market trend, right? So now we have a liquidity sweep above these equal highs, which serves as an early reversal signal. So this indicates that the line break was merely a fake out and then a liquidity run above these equal highs. So now that price has collected the liquidity, it can continue pushing forward in the expected direction. This signal is later confirmed by breaking below this low, right, which is considered a change of character. So you got to keep in mind that all these signals have occurred inside the optimal trading area that we marked on the higher time frame. The entire price action on the 1 hour chart suggests a market structure shift, indicating it's time to place our short entry. So now the question is, where should we place our order, right? Usually in this case, we will look for fair value gaps and order blocks. But in the latest move, we do not have any imbalance in this time frame. So therefore, we have two options. We can apply the retracement tool and place our sell limit at the beginning of the premium area. Or we can zoom to the lower time frame to refine our entry point. Now, let's zoom to the 15-minute chart for a more precise entry. Like I said, this is more advanced stuff, right? So in this time frame, you can see that we have an unmitigated fair value gap area near the swing high. If price returns to this area, it would act as resistance and push the price downwards, providing an optimal entry point for a short position. Let's open a short position with a spread size below the fair value gap and set our stop loss above the swing high. Our first TP would be the swing low. This will ensure a safer exit if price retraces. So now for a long-term target, for a bigger target, we can track our profits and trail it until it reaches the next important level in front of the price. So this is where you will allow yourself to have a bigger RR for larger gains as the trend continue its way downwards. Or you can place it at the next low, the next rejection level in the higher time frame. This is how you can apply your trailing technique. So each time price breaks below a level of market structure. That's where you can adjust and reposition your stop loss above the previous swing high to secure the profits. So for example, you take this green line as your stop loss. So right now, our stop is here. We will continue to adjust it as price move lower to lock in more profits. But every time the market breaks below a swing low, we would reposition our stop loss above the previous swing high. So this method would ensure that you secure your profits while allowing the trade to continue in our favor. Alright, so this way, if price decides to change direction and hits our stop loss, our winning trade will not become a losing trade since we have secured our profits and we can let the trade run without so-called any mental pressure. So allowing us to focus on maximizing the gains while minimizing our risk at the top, right? It's already a free trade. So now, combining all our analysis, including the market directions, the fair value gaps, and the premium and discount zones, we made this entry a high quality trade. So this overall comprehensive approach increases the likelihood of success with great risk management. Understanding the concepts of discount and premium zones is essential for identifying high-quality trade setups. That's where you can apply tools like what? The Fibonacci retracement to pinpoint optimal entry points during corrections. Number 2, combining smart money concepts with price action and market structure shift. They will create powerful framework for your trading itself. So when you combine these techniques, right, that's where you can increase your win rate, because that's where you combine everything together while giving you a really good risk to reward ratio. Number 3, you gotta have patience and proper timing are the key when trading with a strong trend. Waiting for price to enter the optimal zone would ensure better trade execution and reduce the chances of premature entries. What's the worst that can happen? You miss the trade. Other than that, your overall trading perspective, your overall trading setup will set you up to be profitable. Lastly, mastering risk management, backtesting your strategy. These are all very important steps to long-term success in trading. When you have a solid trading plan and consistent analysis, right, that's where you can learn how to navigate the markets. Good? So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.